I bet you didn't know the economy is like a giant roller coaster. It has its ups and downs, moments of exhilarating speed and periods of slow, grinding climbs. Sometimes it even throws in a surprise loop-de-loop. This constant state of flux with periods of growth followed by inevitable slowdowns is known as the trade cycle. Understanding this cycle is crucial for navigating the complexities of the economic landscape. The trade cycle isn't a modern phenomenon. Throughout history, economies have experienced periods of boom and bust. These fluctuations impact everything from job creation and business investment to consumer spending and overall economic well-being. While we can't eliminate these ups and downs entirely, we can try to manage them, smoothing out the sharpest peaks and valleys. That's where monetary policy comes in. It acts as the economy's steering wheel, helping to guide the roller coaster ride and keep it on track. By understanding the trade cycle and the tools available to influence it, we can strive for a smoother, more stable economic journey. But how exactly does monetary policy achieve this delicate balancing act? Let's delve deeper into the mechanics of this powerful economic tool. The trade cycle, much like a roller coaster ride, is characterized by distinct phases. Each phase presents unique challenges and opportunities for businesses and individuals alike. Recognizing these phases is essential for making informed economic decisions. The first phase is expansion. This is the upward swing of the roller coaster where the economy is growing at a healthy pace. Businesses are booming, unemployment is low, and consumer confidence is high. People are optimistic about the future and eager to spend money. At the peak, the roller coaster reaches its highest point. Economic growth reaches its maximum, but this also marks a turning point. Inflation may start to rise as demand outstrips supply. Businesses become cautious about further expansion, and the economy prepares for a downturn. Contraction, the downward slope of the roller coaster, follows the peak. Economic growth slows down, and in some cases, may even turn negative. Businesses cut back on investment, unemployment rises, and consumer spending declines. Uncertainty and pessimism often characterize this phase. Finally, the roller coaster reaches its lowest point, the trough. Economic activity is at its slowest and unemployment is high. However, this phase also sows the seeds for the next expansion. Businesses eventually start to see opportunities for growth, and gradually, the economy begins its upward climb once again. Monetary policy is the art and science of influencing the economy through changes in the money supply and credit conditions. Central banks, like the Federal Reserve in the United States or the European Central Bank, are the conductors of this complex orchestra. Their goal? To steer the economy towards stable growth and low inflation. Think of central bankers as vigilant shepherds, guiding their flock, the economy, along a safe and prosperous path. They carefully monitor economic indicators like inflation, unemployment, and GDP growth, making adjustments to monetary policy as needed. Their interventions aim to moderate the business cycle, preventing both runaway inflation and severe recessions. The importance of effective monetary policy cannot be overstated. It plays a critical role in shaping economic outcomes, impacting businesses, consumers, and the overall health of the financial system. By influencing interest rates, credit availability, and the value of money, central banks can influence spending, investment, and ultimately, the trajectory of the economy. But what tools do these economic conductors have at their disposal? Let's explore the instruments they use to fine-tune the economy's performance. Central banks employ various tools to influence the economy. Interest rates are a key tool, affecting borrowing costs and economic activity. Lower rates encourage spending. Higher rates can cool the economy. Open market operations involve buying or selling government securities. Buying injects money, selling withdraws it. Reserve requirements also influence lending and economic activity. Section 5. Real-world roller coasters, navigating crisis. The Great Recession of 2008 and the COVID-19 pandemic offer stark examples of monetary policy in action, highlighting both its potential and its limitations. In both cases, central banks around the world acted swiftly and decisively to mitigate the economic fallout of these crises. During the 2008 financial crisis, central banks slashed interest rates to near zero, making it cheaper for businesses and consumers to borrow money. They also engaged in quantitative easing, a form of open market operation where they purchased large quantities of assets to inject liquidity into the financial system. Similarly, during the COVID-19 pandemic, central banks implemented similar measures, cutting interest rates and launching new rounds of quantitative easing. These actions helped to prevent a complete economic meltdown and supported a gradual recovery. However, these examples also illustrate the limitations of monetary policy. While central bank actions can help to cushion the blow of economic shocks, they cannot single-handedly solve deep-rooted structural problems or address the underlying causes of crises. These events underscore the need for a multifaceted approach to economic management, one that combines effective monetary policy with sound fiscal policies and structural reforms to address underlying vulnerabilities. Conducting monetary policy is often compared to walking a tightrope. Central bankers must balance stimulating growth and controlling inflation. Too much stimulus leads to inflation, too little stifles growth. Policy changes take time to impact the economy. Global events and interconnected economies add complexity. The dual mandate of many central banks, including the Federal Reserve, is to maintain price stability while fostering maximum employment and stable long-term interest rates. This dual mandate highlights the delicate balancing act that monetary policy must achieve. Price stability, typically defined as low and stable inflation, is crucial for a healthy economy. High inflation erodes the purchasing power of money, making it difficult for businesses to plan and for consumers to afford goods and services. Deflation, on the other hand, can lead to a downward spiral where falling prices discourage spending and investment. At the same time, central banks also strive to promote maximum employment and economic growth. When the economy is operating at full capacity, unemployment is low, businesses are thriving, and living standards rise. However, excessive economic growth can lead to inflationary pressures as demand outstrips supply. The challenge for central bankers lies in finding the sweet spot, a level of economic growth that is sustainable without triggering excessive inflation. This requires careful monitoring of economic data, anticipating future trends, and making timely and appropriate adjustments to monetary policy. Navigating these complexities requires a deep understanding of economic theory, a keen eye for data analysis, and a healthy dose of judgment and experience. In today's increasingly interconnected world, national economies are no longer isolated islands. They are intertwined through trade, investment, and financial flows, forming a complex and ever-evolving global economic system. This interconnectedness presents both opportunities and challenges for monetary policy. On the one hand, globalization allows countries to benefit from specialization, increased trade, and access to larger markets. It also facilitates the flow of capital, allowing for investment in emerging economies and fostering economic growth. Monetary policy can play a role in supporting these positive aspects of globalization by promoting financial stability and fostering a predictable economic environment. On the other hand, globalization also increases the vulnerability of national economies to external shocks. Economic crises, financial contagion, and changes in global commodity prices can quickly transmit across borders, impacting domestic economic conditions. Central banks must be mindful of these spillover effects and coordinate their policies to mitigate potential risks. The rise of global value chains, where the production process is fragmented across multiple countries, further complicates the picture. Changes in exchange rates or economic conditions in one part of the world can disrupt these supply chains, impacting businesses and consumers globally. Monetary policy must adapt to these evolving dynamics and consider the global implications of domestic policy decisions. Monetary policy is essential for managing the economy and navigating trade cycle uncertainties. By influencing interest rates and the money supply, central banks moderate economic fluctuations and promote growth. The challenges faced by central bankers are significant and constantly evolving. Navigating these obstacles requires deep economic understanding and adaptability. As we move forward, the importance of sound monetary policy will only grow. Central banks must navigate technological disruption, climate change, and demographic shifts. Managing the economy is like riding a roller coaster, full of twists and turns. Effective monetary policy can smooth out the ride, steering us toward stability. But can monetary policy alone solve our economic challenges? Policymakers continue to grapple with this question for a resilient global economy. If you found this video insightful, please like and subscribe. Share your thoughts in the comments and share this video with others.